This is for the AQA Business Studies Unit 5 and the Financial Unit. And obviously there's going to be the most amount of formulas within this unit, hence why it's a financial one. So again, I'm just going to pick out the most crucial ones that you'll need to know. Now the first one, A2 students will recognise this because it's pretty much the same as gearing. But in AS it's worded slightly different. So debts as a proportion of long-term funding as a percentage is your debts divided by your long-term funding times by 100. Now when you get to A2 you'll realise that is practically gearing. And all it tells you is if they're expanding, for example, how much of the finance that is contributing towards that, for example, that expansion is being funded by loans or by potentially share capital. Now, if it's by loans, then it can be good because it suggests that you're not losing control via share capital because maybe you're not needing as much investment from investors that might want to say in decision making. However, the issue with having debts as part of your long-term funding would be if interest rates changed, how would that impact your outflows? And also the risk involved with obviously borrowing. If there's any issues with the expansion, as an example, how is it going to impact your repayment? What could be the consequences of that? Your next formula is to do with your budgets. And you have to calculate your budget variances, and that would be done via pounds, but also what's really, really important is that you consider whether it's adverse or it's favourable. So simply with a budget variance, it could be an income budget, it could be a cost budget, it could be a profit budget. Whatever the budget is, you have to work out the difference between the actual and the forecasted budget. And then if it's better for the firm, so for example, if your actual is better than the forecast, then it would be favourable. If your actual is worse than the forecasted, then it would be adverse. So for example, if your forecasted costs were higher than the actual, then that would be favourable because you've actually, in real life, you've been able to reduce the cost, or it's been much lower than what you expected it to be. If for example, your sales revenue is higher as a budget than it is an actual, then that would be adverse because you haven't generated as much sales revenue as you'd planned, so it would be worse for the business. The next couple is based on cash flow. So your net cash flow looks at just the difference between your inflows and your outflows, so the money coming in and the money leaving your business. Your closing balance is your net cash flow, which you've already calculated, plus your opening balance, so whatever you started that month with. And sometimes you might get a cash flow forecast which is incomplete and you have to kind of fill in the gaps. In that case, what you tend to find is the opening balance is missing, and if it is missing, then and you might have the previous months, then what you do is you go to your previous month closing balance and use that. But if you don't have the previous month, then you have to kind of rearrange your formula. And what you do is you do your closing balance minus your net, and that'll give you your opening balance. Always double check with the right formulas to see if it makes sense, but that's how you do it for cash flow. Right, the next one's a contribution. Your contribution is the same formula as added value, which would be in operations, and that is your selling price minus your variable cost. So it's pretty much how much each unit of good, or possibly the service, contributes towards paying off your fixed costs, and that would get you your break-even formula. Your break-even formula is your fixed cost divided by your contribution, and that is measured in units. And just a reminder, your break-even tells you how many products or services you have to sell in order to cover your total costs. So it's when total revenue meets total costs. Your total contribution is where you start to consider your final output as well. So you work out your unit contribution and then you just times it by your output, and that again would be measured in pounds as well as your contribution. Your margin of safety should be a formula that follows on from your break even, and again it's measured in units. So once you've calculated your break even points, then you can work out what the planned output is for the company, and then you can work out the difference, and that would get you your margin of safety, and that would just tell you how many products you've got that would generate a profit. Now with these formulas, your net cash flow you try and want it to be as high as possible. Your closing balance, obviously, you want it to be high. Your contribution, the higher the contribution, the easier it'll be to break even. And your break even units, you probably want it to be as low as possible in order to break even faster and generate a profit. And your margin of safety, again, it doesn't necessarily really matter. I suppose the higher it is, the more profit potential you've got. Now the next part is your margins. So first of all, your gross profit. Your gross profit is the difference between your sales revenue and your cost of sales. And your cost of sales are very similar to variable costs, or your total variable cost, sorry. So that would get you your gross profit. And then once you've got your gross profit, you can work out your gross profit margin, which we measured as a percentage. You'd simply do your gross profit divided by your sales revenue times by 100. And what that would do is it give you a good indication as to, again, what you tend to have is different years, and you can compare the previous years to see if gross profit margin has actually risen. Now, if you break down the components of your gross profit in terms of your sales revenue, your cost of sales, and itself, gross profit, you should be able to find that the higher the gross profit margin, I suppose it means that you are being much more efficient in terms of controlling your cost of sales and generating high levels of sales revenue as well. So your gross profit margin is probably a good indicator that you're adding value successfully as well. Now your operating profit is your final profit. It's sometimes known as net profit as well, and that's you get your gross profit and you simply minus your expenses from that. Your expenses are again very similar to your fixed costs. Once you've done that, you can work out your operating profit margin. So your operating profit divided by sales revenue times by 100 to get a percentage. That will give you a good indication as to how much your expenses are impacting your profit. So for example, you can compare it with your gross profit margins. Is that if there's a significant difference, it might suggest that your expenses are spiraling out of control and they need to be controlled.